Good afternoon, this is Jamie Green of AdvisorOne, reporting from the floor of the Schwab Impact Conference in San Francisco. And I'm very pleased that LizAnn Sonders, Chief Investment Strategist of Charles Schwab, has agreed to sit down and talk about the markets and the economy. But of course, we're at a conference of advisors who always want to know what they should be doing in terms of communicating to their clients at a time when confidence is shaky at best and the markets are volatile. So if you wouldn't mind talking a little bit about your prospects for growth, slow growth, I'm assuming.
Yes, but maybe a little bit more than I think certainly what the consensus has started to believe in a month or two ago, when a second recession was all that expected, and that was never my view. In fact, my view since we came out of recovery in 2009 was the most likely shape of this recovery would be somewhat square root shaped. So you'd get the initial V-shaped recovery and then you'd flatten out from there, and that's about what we're seeing right now. I think we may have marginally better growth in the next several quarters than a lot of people think, but that's by no means to suggest a booming economy, but not bad. 2.5% growth in the third quarter. That, given how much inventory pulled down that number, I think we're not only going to see an upward revision to third quarter, I think that will feed into better numbers for the fourth quarter. So we may be in a little bit of a bright spot right now, but the most likely scenario is 2, maybe at best 3% growth for quite some time.
And you mentioned in yesterday's opening session that the danger at a time of volatile markets is that you shouldn't be shortening your time horizon. So that's what you shouldn't be doing, but what should you be doing? And again,
look,
thinking about advisors.
There's a natural tendency to want to shorten your time horizon when you see this much volatility, when you know that the dominant players in the market have, frankly, time horizons measured in milliseconds, not weeks or quarters or years. I think that temptation is misguided, and I think is a fairly dangerous thing to do, because as individuals, we're not trading like the high-frequency traders with mathematical algorithms. And I think what does happen in a highly volatile environment, it does give you some opportunity to be a little bit more tactical. It allows that process of rebalancing, which we all know we're supposed to do. Pull from the winners, add to the losers, keep your overall portfolio balanced. We're given more opportunities to do that with high volatility. The other frustration, I think, has been this high correlation that has developed. The risk-on, risk-off idea, where all risky assets are moving up in tandem and down in tandem and vice versa in risk-off mode. But we know the fundamentals of those assets or industries are not all moving in tandem. So I think a highly correlated market, assuming it doesn't last forever, highlights mispricings, where something has gone up consistent with everything else and maybe it's not justified, or maybe it's gone down with everything else, but the fundamentals are still quite strong. So if you're smart, you take the time, you take a little bit more of a tactical approach, you can use volatility and highly correlated markets to your advantage.
Part of the volatility we could perhaps lay at the feet of our leaders in Washington. Sure. And right now the so-called super committee is busy hammering out some kind of, we hope, piece of legislation that must be passed by Thanksgiving, or else the automatic cuts. Are you optimistic that that committee will get something accomplished?
I'm probably a little bit more optimistic than most people are. I think the assumption right now is that there's no hope of a compromise that would allow a number to be as big as what is necessary, and that the automatic cuts will happen. But here's a few reasons why I'm a bit more optimistic. Number one, this is very different than in August, because there is that automatic cut that happens if they don't do it. And it happens in a manner that is not palatable to any of their constituents. It exacerbates the justified frustration that the public has with the toxic partisan nature that has become Washington. So I think they know that the public wants them to play well in the sandbox together, and these automatic cuts happen in a painful way. Not only that, I think it's really more on the margins that most of the fighting happens. I think if you think about it, if both sides come to the negotiating table knowing that it's got to be big. It can't just be on the spending side, it can't just be on the tax side, it has to be a combination of both. We've got to tackle entitlements, and we've got to establish policies that allow the economy to grow. I think if you start with that point, I actually think a bigger deal is easier than a smaller deal. And I think I would not be shocked if we ended up hearing that this was bigger than anybody anticipated.
Well, and you mentioned entitlements, and I guess just my final question would have to be looking at things a little bit longer term. We're going into a presidential election season, but the amount of the liability that the United States government has towards even just its citizens, do you think that there will be, assuming that the super committee comes up with something and it's passed in time, that might work as some kind of a model on which true bipartisan approach to solving the debt problem
I
might?
certainly hope so, and I think if there's any positive that is coming out of what we're witnessing in the Eurozone and Greece is the understanding that at some point, if government and its obligations and entitlements grow at a much more rapid pace than the economy is growing, at some point you hit a wall. And I think between watching that and then just the discourse here, I think there's a growing realization that this is not a sustainable path. Right now it's a question of how you fix it, where there are big differences, but I think there's the collective notion that something has to be done here and that we have to figure out how to reform the entitlement system. The devil, of course, is in the details, but I think we now, and we're watching it full steam ahead, of course, in Europe.
Well, thank you very much, LizAnn Sonders.
me.
And this is Jamie Green from AdvisorOne signing off. Thank you.